post-independence, India's growth journey started in 91-92 when LPG was introduced, the then finance minister. And what we have seen in recent times, post 2014, right, we have seen a lot of different narrative has been created in the India's growth journey.
Money will not make you money. See, in your age, I'm talking 20 years back. So he said, first gain experience, because in this market, people who have experience, they take away all the money from people who have money. So it's more important to gain experience, understand where to invest, and that takes time. It will not happen by watching YouTube channels. Please do not take advice from your friends and family members, because
Anybody who doesn't have that kind of credibility.
right. So
to
emotion
advise, yeah.
has to be kept out of this.
Right.
It has to be very professionally and very, very ethically done.
Welcome to My Career, My Choice podcast. My today's guest is Mr. Bikram Saraf. He's a CA and a co-founder of Value Access Equity Private Limited. Bikram, welcome to My Career, My Choice podcast.
Thank you, Abhishek.
Before we start, I was just browsing the internet because My Career, My Choice podcast has been designed for all the youth who is looking forward to develop or take control of their career. So I was browsing internet and I found that every year almost 35,000 chartered accountant passed, right? And in India, we have 1.6 lakhs practicing chartered accountant, and the highest level might be 4 lakhs to 485 chartered accountant are available. So that's a statistics, that's the overall statistics that we have. Now, out of which, very few have gone beyond their practice, and you are one of them.
Right.
Right? So, this podcast, we have an audience, right? And we can have a future chartered accountant watching this podcast. So, first enlighten us your chartered accountancy journey. So, from your childhood, whether this was your aspiration or you have something in your mind.
So thank you, Abhishek, for inviting me to this wonderful podcast. And so I'll just brief out in a very short time that what was my aspiration. So I became a CA when I was in the year 2004. But I was not very inclined to do the traditional practice. So I was always inclined to work in the capital markets, because I saw a lot of future there. Because having read huge number of articles, I felt that there's much more growth which can happen in this country, being not in the traditional practice but being in the full time capital market activities. So that was one of the reason, and I chose a little different path. So what you said correctly is that every year we see thousands of fresh CAs hitting the market, and many of them are confused. And not only for chartered accountants, it's also for the graduates in the MBA, the BCom graduates, the people who are also doing CFA, and a couple of other fields also. I always feel that people should come out of the comfort zone, because CAs typically means that you are traditionally in the taxation, in the assurance audit part. It's not like that. What you said, 160,000 CAs are in practice, but I think we need more specialists in BFSI sector as a whole, banking, financial services and insurance. So that is a huge growth which is going to happen in this country. And trust me, what I see the database is that we need more such people like us. We are just very, very small in numbers to represent this industry. And we'll have to come and understand what are the new areas where, CAs, the MBAs can part with. Because it is not only about being in this area and working in this area. It's also about catching the mega trend which is happening in this country, is that we will see a $30+ trillion economy in next 20 years.
20 years.
So imagine we have around, we can 6-7 times of 8 times of growth which is left in next 20 years. So who is going to address this? We need people.
We need people.
Right.
Being a commerce student, Vikram, when we were studying commerce, and accounting was definitely part of the subject. So there was a proverb which has been written in one of the accounting book. I'm just recalling that particular proverb. It's been written that when a CA enter from the front door, it's a CA. But when the same CA enter from the back door, is an auditor.
Right.
So we have learned that that's a dimension, a CA and an auditor. But you have gone beyond that,
Right.
right? So give us some enlightenment about the value access equity firm and what activities you people does over there.
So what we saw is that there's a massive growth. You see, growth when I mean it's a very a subjective term that growth has happened in all the developed countries already. So we are a developing nation and we are going to become a developed nation by 22 years, in next 22 years when India completes 100 years of independence. And I have no doubt in it that we are going to do it.
Nobody has a doubt in it.
Right.
Yeah.
Now, the point is that we are at an inflection point. We have to understand that we are at a $4 trillion economy. Now, India took 75 years to become a $4 trillion economy. Now, India will take another 20 years to become $30 trillion economy. So, you see the pace of growth. So, the minimum requirement has been done. So, in our company, what we do, we have asset management division, we have wealth management division, we have IPO advisory where we are also going for a merchant banking division now. We have a multifamily office. So what we are catering is that we are catering to the hyper growth sectors of India, which we feel that if this country has to grow, 15-16% of growth in the corporate sector and 7-8% of GDP growth, then who are the people who are going to benefit the most? I feel we are the people who are going to benefit the most, along with the large corporates, mid corporates. So we are serving ultra HNIs, we are serving the mid corporates, we are also serving the affluent class of the country where they are so busy making money, they need to be served in the other side of their story also. They have to create wealth. Everybody is making money, but creation of wealth is altogether a different subject which you need to deep dive a little to understand more. So we have this 4 division and we are sitting in Mumbai, Calcutta, now starting in Bangalore, and we feel that we are in the right time at the right place. Countries which have US did very well post 1980s. Japan has done very well after World War II. Korea, South Korea, Taiwan, China, they have all become now developed. So it's our turn now. And professionals like us who are in this industry, we feel that the time has come when what I say is that the time has come to do a very, very big jump, not only in our growth but also in terms of our spreading our wings. So that's all. I think it's appropriate time.
If I'm not making mistake, you can correct me. Post-independence, India's growth journey started in 91, 92 when LPG was introduced, the then finance minister. And what we have seen in recent times, post 2014, right, we have seen a lot of different narrative has been created in the India's growth journey. So pre-independence India, post-independence India, and this 2014 to 2026 where we are standing right now, the growth factors has increased tremendously, right? We have seen the investment part, the startup valuations, all these vocabularies have came into the mind of the Indian startup ecosystem. People, because when we started our business, we never thought of this word startup, valuations, investment and all this stuff. We started like running a business. But nowadays, people is more focusing on valuation game. Give some insight knowledge to somebody who is planning to start his own business. What kind of foundation he should make in the initial phase so that he can be a part of this valuation game?
So that's a very good question, Abhishek. So I'll just brief one thing that, there are two kind of founders in India. One who are bootstrapped, they are first-time entrepreneurs. They are starting with no capital support from
No angel investor. Parents are their own angel.
correct. And Lot of founders, they
Right.
get initial capital and support from their families, because
Right.
either their parents or their grandparents were into business, and they have sufficient capital to start. So especially for people who are first time founders, they are very passionate about their work. They on day one, they believe that they will work very hard, they're passionate, so they will be very successful. But I think it's a very wrong notion, because business is not only about passion or capital, it's much more beyond that. So he has to figure out that he will need to take a lot of help, professional help, lot of help from the outside ecosystem, because even a vehicle has four wheels, so one or two wheels will not be sufficient for him. So capital may be one of the wheels, the other support system can be one of the wheels. So what I'm trying to tell you is that they have to be more collaborative. They have to go and find out, do a lot of homework in terms of in which sector they are, first of all, and are there tailwinds in those sectors, are there real growth lying for this country in that particular sector. So he has to do a lot of homework. Obviously he has to talk a lot of peer founders, or maybe the people in those sectors. Those homeworks are very, very important. He has to be also in the right market. Many times we feel that some founders, they are possibly sitting in northeast of this country, or maybe in the eastern part of the country. They may not be accessible to a lot of capital initially. For them, the ecosystem will not support initially. I don't say that these are dead areas, but you have to be more in the hyperactive areas, so that you every evening or
Most of the business founders start their business from passion.
correct.
They don't do any kind of feasibility study of the market.
So I
Right.
as you said correctly, passion is, too overrated a subject. So they'll have to figure out couple of ways that, apart from raising capital, apart from the right product fit which they have to make, they'll also have to figure out the entire the process. Let them take much more time to launch their products. Let them be a co-founder led team. Single founder businesses are not being very greatly looked upon, because we are not in the era where there was a one-man show and the business used to do well. Now even a Boeing needs two pilots, right? So a business has to have two or three founders.
And standard operational procedure has to be written perfectly.
Right. And the founder should not be in too much of hurry to launch his product. He has to do a lot of homework. So capital is again a subject which is required, but I think it is overrated in terms of necessity. So there can be a lot of value addition from external people, external professionals, and he also has to know the fact that from which institutions or which funds he can get his capital. So there are very domain specific funds. A fund in the defense sector may not invest anything in the supply chain of AI, right? So he has to have that knowledge that which are the funds, which are the family offices, which are the HNIs who are experts in his domain area. So blindly chasing the market will not help. Blindly chasing friends and families will not help to raise too much of capital. So those homeworks required a lot of brainstorming, a lot of working at the backyard. And obviously, take a passion, what you said is correct, but end of the day, passion will not give you capital, right?
See, I have doing this advisory job for a pretty long period of time, not the financial advisory, but business management consulting. And I have found two type of founders mindset, right? One founder mindset says that this is my business and I'm not going to share it with anybody. I have created this business, I'm going to nurture it, and this business is going to stay with me for the entire life. My next generation, third generation will look it after. So they are not in the path of valuation, fund generations, or investors or external investors, right? This is one kind of founders mindset we have seen. There is another kind of founders which normally post 2014 I've been interacting, who already before the start of the business, they already have set up their mind that this is going to be my exit plan.
Right.
This is going to be my exit plan, right? So I'm starting my business in 2026, and in 2028, I'm going to get the initial investment, then Series A, Series B, Series C, and then IPO. I'm going to exit. So this is two mindset we have. I particularly have interact. Now, can you just give me some insight narrative, because you are the right person to give a clarity on this kind of mindset, because you are the one who give advisories to family run business for the second, third generation, right? You are the person who manage quite a big number of funds, right? Where you place those funds in so many organizations and investment strategies and everything you can plan. So give me this two type of mindset. Which mindset you think is one of the best?
So what you said is, one is a fixed mindset and one is a flexible mindset. So any founder, any businessman who is starting his own venture, new venture, he cannot be rigid on day one. First of all, he doesn't know that what kind of navigation he has to do down the line, right? So there is no point, having the fixed mindset that I'm going to own 100% of the equity and I don't want to dilute, and I'm going to suffer the way I'm doing, suffering, and
Cash flow issues and
cash
everything.
flow issues is there. He knows the fact, but he's rigid in terms of his dilution. So it's not going to help him. You see, there are examples. You see, Facebook, Mark Zuckerberg hardly owns. He owns less than 15% of the Facebook, right? But he's still controlling majority of the holdings. In terms of voting power. So he has, what I understand, is more than 60% of the voting power, but he still owns less than 15% of the holding. So it's a myth that if I own the company, I'm going to grow it. So you can, as in the Western countries, you need not own the company to grow it. So that's a myth. So in India, generally, there's a myth that I have to have 51% of the equity. Yeah, that's a benchmark, you can say. But then always
That's a controlling equity.
Correct.
But controlling equity is not a guarantee that you are in the right track, right?
Correct. So that's a myth. So if the need of the business is capital, the need of the business is talent, and the need of the business is also to retain the right kind of talent. That can only be retained by having the equity being spreaded among the right kind of people, right? You need to have ESOP policies. You need to have sweat equity ratio policies, right? So anybody who is rigid to control the board without having a long-term vision of 7-10 years and sharing the equity, there are very high chances he will not do well.
Right.
So he has to share.
No, as per the company law, right? If I get inside the company law itself says that any company is an artificial person. Any company is an artificial person, but unfortunately, the company law has not given the narrative. So what is going to be the gender of that company, whether it's a male or female?
Right.
Because the traditional mindset of the entrepreneur who has started the business might be 20, 30, 40 years back, they consider their company as their son. Okay? And their son means is going to be with us. चाहे बाहर से बहू भी लाए, लड़का घर में ही रहेगा.
Correct.
ये मेरा mindset है. Now, 2014 onwards, the mindset of the entrepreneur has changed. They started considering their company as a female. मेरी बेटी है, बेटी को तो ब्याह देना ही पड़ेगा, तो sacrifice करना पड़ेगा, dilute करना पड़ेगा share, and then only you can make lot of money out of it, right? Now, my question is, we have seen in the first mindset, the second and the third generation, when they enter into the business, they have a different type of mindset because they are this generation kids and their parents are traditional businessmen.
True.
They face a lot of struggles because maybe they are interested in some other business and father is doing a different category of business. Maybe there is a wealth, right? But these kids are not interested. They want to do something different, right? You play a very important role in this kind of situation, family advisories, right? So just give me one or two case studies. I don't want you to narrate the name of the company, any one or two case studies which will give them that yes, with this kind of strategy or advisory,
Right.
this family run business can sustain itself? Any
So
example?
it's an interesting question. So I'll just come straight away come to a very important point that uh, the traditional businesses who have built a lot of assets, they are cash generating businesses, right? Profitable businesses, and possibly they are run by people who are born in their 40s, 50s, or 60s, right? So the new generation now, they have understood that their parents and the legacy is sitting on the book value.
Right.
It is not sitting on the market value.
Right.
So the entire share price, the equity price is on book value. So they have not at all got the benefit of the fair market value.
Right. Access भी नहीं है.
Right.
Most of them doesn't have the access.
And when the other generation has come after studying maybe from Ivy League, or maybe from some B
Top
schools
universities,
in the Europe, or maybe in India also, they can clearly differentiate what is happening in the developed countries, what is happening in the Silicon Valley and Bangalore, and they see that they can jump 10x. So when they can really see that this valuation difference is there, why not take the benefit out of it? And there lies the struggle, because there's a difference of opinion, there is a difference of mindset. Now, as you asked about an example, I'll give a very latest example from this city of joy called Kolkata, where I know a business house. They were traditional jute owners. I mean, they did a lot of jute trading and they made a lot of wealth. And their son are now running a co-working space, which is a listed company in India, and they have done exceptionally well. Now, these are two different, sectors. The children did not come and join the jute businesses, though there was money, though there was wealth. And they knew that this jute business may not be able to do so well in the equity market, or maybe in the capital market, right? Because there is no innovation in it right now. It's highly regulated.
Trading-based business.
It's a regulated business.
Regulated
right?
business.
So they have now set up a listed company, have scaled up, adding a lot of value in the co-working space. So what I'm trying to tell you is that even the new generation is doing well. It's only a difference of mindset. And that alignment is very important. And that alignment can only happen with a lot of discussion, a lot of brainstorming, a lot of meetings with people who are domain expertise. And there are numerous examples like this when children are not at all interested to join their father's business or grandfather's business. It is not because their businesses are not good or they are not making money. It is because they don't see a lot of value from their side to be added. They don't get a lot of kicks to do those businesses. They are equally talented. Both the parties are talented.
So what happened? So this case,
So it's a very classic situation that either you kill the business, because who is going to take over those old traditional businesses? So it is very important to gradually, create that culture, bring the right talents. Ultimately, it has to be under succession planning, right? The company has to go on if the business has to survive. Now, who will do it? So if their kids are not joining it, so it's a very important part that the board has to be now turned into a professional board. Where
and you have mentioned one succession plan,
right?
Which
So the CEO has to be hired, or CFO has to be hired, and to run the organization. And it's not easy because they do not have structure in place. So that, and it's not about paying high salary and somebody will come and join you. It doesn't work like that. People come join not because of only high salary, but because of the stability in their career also, right?
right. So also they have to link with the passion. The CEO who is coming, he has to incline with that particular product line or service line,
Right.
where he's been heading, right? If he doesn't have that interest, only joining as a CEO is not going to change over.
So sudden incidents may destroy the entire company. So it's
What
very
type of advisories you can place?
so we
For
think
if we consider this as a classic case, right? So what type of advisories? Because there are a lot of my audience might be they're into family-done business, and the parents who are watching this particular show, they have given their entire year life to develop this particular business. It's very heartful for them to understand that this business is not going to survive after me.
this is a very, very helpless situation, and
Right.
this situation doesn't have a solution which can be formed in a day or a month. It's a cultural problem, and it has to be nurtured maybe in 2-3 years. Create that culture within the organization. Try to bring good people gradually, because people are not getting, talent will not get attracted just because you are going to pay more. So it's the irony of this country that family driven businesses are facing a lot of challenges. So they should gradually, there's one very important way where they can transform their businesses by having the businesses getting maybe listed in small and medium enterprises exchange, SME exchanges.
Right.
So that business becomes more structured, more robust. Then they can attract talent because of regulation also.
Right.
And gradual handover can be done, because then there are external shareholders. Maybe you can become a takeover candidate if you are more structured. Otherwise, you'll have to make a distress sell. If you don't have kids, or if kids are not going to participate.
And founders can also generate a lot of money
Wealth.
out of it. Wealth,
Yes,
right?
yes. So if you are not structured, you cannot sell your business. You will have to be selling in distress value, right?
Right.
So that planning takes 2 to 3 years. It's not a transaction. It's a journey, right?
It's a journey.
So you have to understand. You have to bring the right advisors, right people to structure it. And that's again a problem which a lot of people are not willing to take that step, because they feel it's easy. It's not easy.
easy.
It's a process, and you have to have the right team.
Right.
But yeah, things are changing. I mean, people are getting more and more aware. So that's a good thing.
Right. Because we have seen the mindset of this family run business is changing a lot, because now the traditional founders are becoming more and more flexible. And you have correctly said that this kind of succession plan, some of them are definitely adapting, because and the generation, the second or third generation, they understood that whatever wealth, whatever asset my father or grandfather has built, it has a definite and indefinite value as well, right? So if it has been structured in a perfect way, then there can be a wealth legacy, we can say, that can be created. So they need right kind of advisories. And you are one of the handful person in India, very few people in India does this kind of advisories, right? Right. So there are n numbers of case studies you have.
Yes, yes. So I think it's very important to understand the technicalities. It's not so easy as it looks.
Right.
Most people are not aware.
Right.
So every house, every business house should have their succession planning and estate planning in process.
Right.
And it's not a one-day process, and there are a lot of technicalities in it, because if your businesses are being, if the ownership are being transferred and into private family trust, into business trust, then the perpetuity comes, right? So those become perpetual.
Right.
So instead of becoming the business owner, you become the beneficial owners.
Right.
And there is a huge difference in both the terms.
Right.
So once you become the beneficial owners, your entire future legacy is protected.
Right.
You are ring fenced. You don't have any liabilities. Your personal expenses are being taken care of. Your journey becomes much more transparent and clearer.
And easier also.
Sudden loss of family members will not create a ruckus, ecosystem. And a lot of peace of mind. I think the Gen Zs of the world are not chasing asset, they are chasing experience, and we have to understand this very, very clearly. Assets are, you see, so many people from Calcutta, I know the old age parents, they are not visiting either US, or the kids are also not coming every year. So you have to understand these kids can have access to few millions of dollars in the city by assets, but they are not interested so much.
Right.
They are also doing a lot of distress sale. So the experience and the comfort is much more valuable than the price of the asset. And the difference is very, very visible when we do, discuss when we are doing these transactions. Yeah, so succession planning is very important. I think every founder or businessman should mandatorily take out some time, sit with people like us, or maybe their advisors,
The consultants,
and at least understand the process. Because it's not a one day affair. You just go, and it's not a movie ticket you go and buy and watch and come back, right? It will take a lot of time.
2-3 years minimum.
Yeah, but ठीक है, succession planning can be driven and done in maybe 3-4 months. That's not a
Right.
problem. A lot of people are in fact doing with us, so
Right.
we know how important it has been for their life.
Right. And the next topic which I'm going to discuss with you after this family run business, what is going to be the future of the small, medium size or mid sized companies in India in next 10, 15, 20 years?
Abhishek, I am very passionate about my work. So what I have understood and is clearly visible is that India is a capital-starved nation, and we need capital. We have money but no capital, and the supplier of capital is so limited. Especially the banks do not have the bandwidth. They have, but they do not have the liberty to fund all the MSMEs. And there are no other institutions. I mean, they do not have the muscle power. So, private institutions like AIF, they are coming big way. They are funding. The venture capitalists of the world are funding. And out of more than 6 crores MSME in this country, I mean, what I see is that few will become very, very big, and only those will become very big who have who are willing to go beyond their comfort zone, who are willing to have access of capital and talent with I'm assuming that they have a very good, robust product line, because without a right product, they are not going to survive. So good talent, good capital. I mean, institutional capital can give the leverage to scale. They have to spend more time looking for equity. The equity as a capital has been underrated in our country, if you see, especially for the MSMEs. So a major time also should go and exploring the right kind of capital from various institutions. Private credit is a very big market which is coming in India, and little extra buck of interest will not harm them. But credit is available, equity is available, and please, my request is not only chase banks, chase these institutions.
So, see, we interact with a lot of business house, might be startup, mid-size, or small and medium business. And in most of the cases, what we found that they are not investment ready company.
Right.
They're not investment ready. They all want funds. They have a cash flow issue, but they're not investment ready. So when we talk about this VC funding, the Series A, Series B, Series C, whatever may be the funding, so these companies are not ready, and they are not meant. See, we only have a handful of big five consultant in India, right? But their consulting fees is pretty high, right? This mid-sized company or small startups, they doesn't have that kind of capital access with them to invest, to do the feasibility study, generate a investment-ready company, and then they approach to the investors, VC funds, and definitely then if everything fits on the bill, they will definitely get a series of investment. But these people are not ready. So what kind of advice you're going to give it to those companies who is not ready, because most of them aspire to get fund, but readiness is more important.
True.
Right? So what kind of, you must be encountering with many such companies, right?
And
we also encounter.
And there are two aspects to it. One is that you see, first they have to understand that they have to know that they do not know. I mean, this is very
important aspect.
They do not know that they do not know. I mean, so first they have to understand this, and there are two aspects to it. As I said, one is that a business aspect which they are good at, so they are more focused on the business side. But then there are certain milestones which they have to cover, not only with regard to business but also with regard to their structuring, compliance, structuring, getting the right kind of structuring done, or what are the steps in structuring, what are the steps in compliances, what are the steps they have to follow. They are not aware. So they feel that what they are doing is correct.
Right.
And most of these startups are actually getting closed in first 2-3 years of their operation. I mean, they start very big. Ultimately, they don't reach Series A, right? So if you don't reach Series A, I mean, you are dying before even maturing. So my advice is that, first, uh, don't only concentrate on the product.
Right.
And it is the problem with the founders is that if they do not have a 4 to 5 core team member, they cannot, segregate their responsibilities. So everybody can do everything, but the point is that you just have 10 hours of working, right?
Right.
So you can't
So they have to outsource.
outsource, or maybe you have to divide the responsibilities.
Right.
That is very important. You have to keep trust. You have to respect your board member, I think. So those steps will be gradually worked out, and you have to set a deadline. A lot of things founders feel that no, this is not required, but this is required.
Right.
I mean, whoever comes and puts money, he's not coming only with the mindset that he will get return, right? He's also coming with the fact that he wants his return on, not on capital, return of capital. That is also very important.
Right.
So how will he get his capital back? Exit is very important. So that
Right.
startup, those founders have to understand
Right.
how are they going to get exits.
Right.
So nobody is thinking that. People are more bothered spending time on getting the money. But
Right.
the other side of the fellow, he needs the clarity, right? How he wants to exit.
Right.
So those are very important factors. Simultaneously, what I see is that, you have to chase professionally to raise capital.
Right.
So it's not easy.
So when
doing
we
that.
talk about exit for this kind of companies, the ultimate exit plan for them is the IPO.
Need not be, because India is seeing a very, very robust secondary market operation, which what I'm observing, many founders do not know this.
Right.
So even before IPO, there is a secondary market which has evolved very big in this country.
So enlighten the audience on that.
So there are two ways where the investors can exit.
Right.
One is the IPO, and where they can sell their shares. But even if the IPO doesn't come, if good companies are getting traded in the gray market,
Okay.
so it need not be traded in the exchange. Those are being traded between two individuals.
Right.
And these transactions happen offline, but obviously mostly through their online demat to demat transfers.
Okay. So
And
you are talking about this pre-IPO or?
Yes. So those are the transactions in the pre-IPO side.
Right.
So if you are pre-IPO eligible, in terms
That's the secondary market.
of secondary
you're
market,
talking about.
right?
Yes.
So there is a very big secondary market in US.
Right.
China is also having a good secondary market. Now India is seeing that. Now you see a company like National Stock Exchange, which is yet to get listed.
Right.
But as an individual investor, you can buy shares of National Stock Exchange even before it has come for IPO, right?
In the secondary market.
Right. So
Right.
founders have to understand that they should be ready to, they should be prepared in terms of their company, so that their equities can be traded in the secondary market.
Right.
Once your equities are traded in the secondary market, a lot of exits can happen. So liquidity can come, right?
Right.
But it is not easy to come in the secondary market, because there has to be a goodwill. Trust
It is
has to be there.
regulated very strongly.
No, but then
right?
there has to be buyer and seller. Buyer and seller only comes when the company has matured, right?
Right. Because at the end of the day, whoever is buying the company in the secondary market, his ultimate intention is to sell it in the primary market in the IPO.
Correct.
Right?
He may not also,
He may not.
because he may be a very ultra HNI investor. He may be a long-term investor.
Okay.
And he may like to retain, right? So
Okay.
I hold a lot of companies in the secondary market, and I feel that I'm not going to sell it for 4-5 years, because for my company, we look is that we are going to make 20x, 30x out of it, right?
Okay. Because the business must be doing well, and
Exactly.
the structure of the business is so
Exactly.
robust that they are not getting the willingness to
Correct.
go into the primary market and launch their IPO.
Right. So a lot of shareholders in NSC they are not sellers.
Right.
So what your question is that the exits can happen, need not be in the
IPO stage,
but also
right.
in the secondary market. And India is having a very robust secondary market as of now.
Right.
And this is one particular thing which a lot of founders do not know. They have to know that they can be eligible for their transactions in the secondary market. So get prepared for it.
I was just reading one news in Economic Times that in India, in next 5-10 years, there are so many companies who is actually getting themselves listed in IPO because the company's listing race has already started in India. Now, what is your opinion? How many of them will be able to sustain?
You see, this is a very difficult question because India has 7,000 plus companies listed right now.
Right. And every year, how many companies
And
are?
roughly 400 plus companies are getting listed,
So in
right?
next another 10 years, we can anticipate 5,000 companies.
So my figure is I'm little optimistic. So I feel in next 10 years we'll see around 7,000-8,000 companies.
7,000-8,000
at least.
companies are listed.
And you see there are profitable companies and capital is a shortage in this country. So how will they raise capital? Right now most of the IPOs are getting oversubscribed. So ultimately the wealth which is lying in the current account or as savings account of Indians, they have to come and participate. Otherwise, they will not be able to beat the inflation, right?
Right.
In US, you see, participation is more than 45%, 46% in the
And
equity
India, what is the
market.
percentage?
India is still single digit. We are less than 10%. I mean, we are 7-8%.
Why? Why people are not
Awareness is
participating?
not there. Awareness is not there. Right platforms are missing. People are
People are losing money as well. In the primary market, we have seen people are getting wrong advisories from their
but
broker.
you see, that's a part of the ecosystem.
Right.
I mean, people initially will lose; they'll become little more mature.
Right.
Participation is more important, I believe, because once you start, people have not lost money in mutual funds, right?
Right.
So people have made money, and direct equity is a difficult task. So I think mutual fund investments are right now. We are catering more than 30,000 crores every month.
Right.
This figure is going to go high from here. So more retail participation
That's
happening.
a more regulated part. You have a fund manager who is managing your fund.
Correct,
and
correct. Ultimately, this money is going.
he understands the skin of the business. That's why your money is, the risk factor is
Right.
lesser in the mutual fund than the stock exchange. Because in
Right.
stock exchange, people are more greedy. They want to make.
But you see, it takes time to become a pro, right? So people initially may lose money, then they will learn the process. Who are more interested, people who do not have time, who don't understand, they'll go through a mutual fund route.
As we know, the definition of profit, which says profit is a reward of taking risks.
Right.
If people want to make profit, they have to take the risks. That's a ball game, because if you don't take risks, at the end of the day, you're not going to get profit. If you sit in the home and just fantasize that your wealth is going to grow, right? Or you are a very traditional investors who want to place the money in the fixed deposits or secured investments, right? So the rate of return is much less.
Correct.
Right? So IPO, pre-IPO is also one of the very interesting factor, right? And as an individual, they can also invest in pre-IPO, right?
Absolutely. And you see, I consider that any investor who comes in the pre-IPO market, people who are little seasoned, right? Who understand equity market.
Right.
So I will just deviate from this subject that it is very important to understand a person's risk appetite.
Right.
And if your risk appetite is little higher, if you are young, then you also need to understand what kind of asset classes you are going to invest.
Right.
And you should have an asset allocation.
Right.
So these are two important strategies which you
Right.
need to understand first. So if you understand asset classes, there are various asset classes, like people have been investing in gold, equities, mutual funds, real estate, provident funds, in FDs. Now there are a lot of new asset classes. We have asset classes in the alternate side. So alternate asset class is something which will give you more reward, and it is little risky also.
Right.
So in that context, I think once you understand asset classes, asset allocation is very important.
Right.
So if you do asset allocation properly, which will require a lot of professional help.
Right.
So you are basically diversifying your risk. You are taking care of the volatility, and you are obviously taking some part in the very riskier asset classes, like the startups, like the early stage companies, like in the AIF space. I mean, there are very specific AIFs in the PMS.
Defense space also, people are
Right.
more interested.
So there, if the asset allocation is properly designed as per your age and risk profile, the chances are you'll do well in next 5, 10, 15, 20 years. Obviously, time horizon has to be considered. And this is not easy because it's more like a surgery. So we cannot do it for ourselves. I mean, even if you're a doctor.
Right.
So that mindset is coming, and it's time, when we say that in Wall Street, people come in Ferrari and Rolls Royce to take advice from people who come in tubes, right?
Right.
So India is now seeing that situation. I mean, people, the affluent class has to come to very good professionals and advisors because they cannot do it for themselves. It's impossible basically.
Wealth generation itself need a structure advisory. Unless and until you have that kind of structure advisory,
It will not work. It will not work
It will not
because
work.
money will not make money. That's a myth now, because you have to be invested in the right asset classes, and this cycle keeps on changing. So you have to be very, very expert. You have to be
You have to understand what is going on. The geopolitics and everything has to be
Everything.
analyzed properly.
And I don't believe there is anything called very long term. I mean, the dynamics are changing so fast. So
The narratives are changing because previously, as an investors, people have a long-term vision, right? Or a traditional investment protocol, like putting the money in insurance, generating fund out of it might be 10, 20 years down the line. So that's a different category of investment. You should invest in insurance to protect your family, near and dear one. But when times come for generating funds, right, you have to consider something different, alternative path. That what you are mentioning is absolutely correct.
Yeah. So exit is also very important. Right time of exit when the valuation goes very high. Compounding is one of the best stories of the world. So we also have to understand where compounding can happen. I mean, there are asset classes where we know compounding cannot happen.
Right. So you must be advising many HNI and affluent classes, right? So what kind of advisories you normally provide them? And say, for example, if one of my audience who is not from that HNI or super HNI or affluent class, he wants to get into that particular status, right? What kind of advice you're going to give it to them as well?
You see, it's very important to understand yourself first. I mean, what is my requirement in the long run?
Right.
So every person is different. There cannot be a comparison between two individuals.
Right.
So every person has to understand what kind of aspiration he has in life, what kind of requirements he has in life, what kind of positioning he sees after 5 years, 10 years, 15 years, 30 years,
Right.
and what kind of actual money he's making as of now. I mean, he needs to have that benchmark done that after 10 years or 15 years, I'll require this much of money.
Right.
So he cannot, fancifully be thinking that I need billions of dollars. That cannot happen, right? Because your base capital is also very important.
Right.
How do you start?
Right.
So participation, the base capital quantum is very important. And once you understand what is your requirement, then there is an investment policy document which can be made. I mean, every policy document is different, and the taste is different. The risk appetite is different. I say there are risk capacity and risk ability. Both are different. So every individual has to understand this family structuring. What kind of family members are there? What kind of need is there? And whether he's a high risk taker, depending on his age. So there cannot be one size fits all story. It's like, different sizes will fit to different people, right? And this is a very, very, very detailed working which needs to be done. But obviously, he has to start building. People have not made money in traditional asset classes. Like I know a lot of people putting money like left and right in insurance, and they have not got anything, right? So asset allocation we have to do. And obviously, if we have a horizon of, at least minimum 4-5 years and beyond. So I don't see, any issue in terms of growth. We will definitely beat the inflation very nicely. And you see, if you are making 26% every year, your money doubles in 3 years, right? So idea is, you should be happy with somewhere around 17, 18%, 15% plus is very good return. And how many people are able to do that? So everybody is chasing, double digit high returns. That is not possible.
Now, we are coming to the end of this particular podcast, but before we close, it will be very unfair for my audience if I don't ask you the three important case studies. Just imagine a student who has just completed MBA and got a placement. Might be in his 26th, right? He's 26 years old. Got a placement in one of the top MNC company and earning an annual package of 18 lakhs, right? And living in a city like Calcutta, let's pre-assume, because we love our city, Calcutta, right? So if this student comes to you, because he has entire life to build his
Right.
asset, right? If this category of students comes to you, what kind of advisory you're going to give it to him? Who is earning 18 lakhs in his first job? Might be he have done a MBA from one of the top B schools, right? The second category is we have another case studies where a man in his mid 30s has worked for 10 years, struggling because he's a working class, got his earning up to 18 lakhs, but doesn't have any kind of savings. He has his own family, he has his own commitment to manage. Now, in mid 30s, he wants to make some wealth. What kind of advice you're going to give it to this particular person? And the third is a person who has just retired, having a retirement benefits of 50, 60 lakhs in his hand, but has a little bit of commitment for getting his daughter marriage, right? So what kind of advice you're going to give this three category of three generation, I might say? What will be your advice?
Okay, so what you said about the first category is like 26-year-old person who has just started his career, getting his first paychecks. So he has big dreams, right? So in majority of the cases, what we have seen is that he has now aspiration to buy a house, get married, buy a car, enjoy life, settle down. Everything requires money, and it is during this period he also likes to take a lot of risk. So in many cases we have seen the kind of money which he makes in his salary and through maybe some family wealth getting transferred to him, he takes a lot of unnecessary risks which are not required. For example, he goes and buys some crypto, he will go and open a share trading account, make some trading, and in most of the cases, most means majority of the cases, 90%,
80% and plus, or 90%.
he will lose money. Again, he'll have to restart in next 3-4 years because his cash flow is gone. So the first advice is please do not do all those kind of things. It will not help you because you have to do a lot of net practice before hitting the stadium, right? So in first 4-5 years, be a little conservative, learn the game, because I'll share a very important thing that I met Mr. Ramesh Damani once in Bombay Stock Exchange, and he said money will not make you money. See, in your age, I'm talking 20 years back. So he said first gain experience, because in this market people who have experience, they take away all the money from people who have money. So it's more important to gain experience, understand where to invest, and that takes time. It will not happen by watching YouTube channels. So that is one thing. Second is talk and make friends in financial markets. Please don't, since maybe you are a graduate from some BTech engineering college, or maybe you are MBA, so we tend to sit with comfortable friendship ecosystem, right? So make friends who are in the capital market, understand, and don't fall in trap with short-term income. It will not work. Ultimately, that money will go away. Build your corpus. Start maybe with small investments in mutual funds. That's the right way. Don't go for big insurances. Don't go for endowment. Just buy maybe a little bit of term insurance, because most of these marketing people are going to come to you and ask for insurance schemes and all. It will not work. It will not help you. Third is that, start saving. That is very important. And once you have that decent capital, your mutual fund will also grow, and you will start understanding the market activities. Maybe participate 4-5% of your money in good pre-IPO companies. Go and participate in maybe good IPOs. If you are lucky, you may get some subscription. Put some money in different asset classes like gold, silver, so you can balance it. And possibly the idea is not to make mistakes. If you don't make mistakes, you are in a far better situation of growth. And most of the youths are losing money in crypto and in various kinds of blockchain
Intraday
assets
trading.
and trading.
Quick money.
Quick
method,
money आएगा
yeah.
ही नहीं. I could not make.
Right.
Nobody makes. It's a myth.
It's a myth.
It's a myth. So,
Right.
because there are pros sitting in the market,
market, right.
and there are not only there are pro in the machine learning space also. So you cannot beat them, right? So that is one thing. Second is people who in the mid-30s who are still struggling or
To
have
generate some wealth,
aspiration.
yeah.
So every individual is different. So again, he has to figure out what he wants in life. He cannot have everything in life, but definitely he can some things which he feels he needs. Right? Maybe a good house. So that is again a very very specific planning consulting he has to do. And I suggest don't go and consult with your income tax filing consultants. Find some good folks in the market who generally are experts, and they are quite old. They understand. They do not have only product interest. They will help you also. Obviously, their product interest is important, but they should not be buying those products which serve their company, right? So unbiased, you should get opinion, and obviously, gradual savings will help them. Asset allocation, asset classes, they have to understand deeply. It takes time, 7-8 years to build portfolio. Possibly a person in early 30s or mid 30s can, spend maybe 7-8 good years. And the best part is that we are in a very growing market. If you take 4, 5, 10 years horizon, we are here to grow exponentially in couple of sectors. So understanding that is very important, but obviously through professionals.
So wealth creation, you mean to say, is a habit.
It's an habit.
It cannot be a hobby.
No,
it
and
cannot be any quick earn money formula.
And it's a very deep subject. If you want to really grow big, you have to read a lot. You have to understand what the veterans of the industry have done. So you just can't copy paste. It's a mindset. It takes time.
And the third case is?
And third case, I say, since people who are already reached their 60s, it has to be more a protection game. So they cannot look for returns beyond 7-8%.
So fixed deposit is an ideal format for
need
them.
not be only fixed deposit. Again, I say maybe they can have some kind of returns which are regularly plowed back from the market.
A little bit in pre-IPO market.
If not pre-IPO, I will suggest them that their asset allocation should be such where they can put some money in fixed deposit, but also in some money where they can participate in liquid schemes of mutual funds where they can regularly get monthly withdrawals. There are some very AAA rated NCDs and which are being issued by the companies, some treasury bonds and all. So they give little better return than fixed deposits.
Right.
So they should not look for very lucrative returns because ultimately they'll have to enjoy life, whatever balanced life they have. And but then there are cases where they should figure out what kind of monthly expenses they have.
Right.
And obviously that entire money is not needed in that particular year, right?
Right.
So that planning is very important so that maybe 10, 15, 20% of their assets can be participated in little riskier asset classes where, they get that little extra alpha. But again, that will require a lot of understanding.
Right.
So it's not a plain vanilla any suggestion, but again, person to person, background of the family, what kind of debt they have, whether they are going to able to serve their debt properly or not. So yes, but the more you are aware, I think the lesser mistakes you will do.
Right.
So everybody has to understand that They have to
It's a structured process.
structured process. It will not work just because your friends and families are advising. My genuine request is that please do not take advice from your friends and family members, because
Anybody who doesn't have that kind of credibility.
right. So
to
emotion
advise, yeah.
has to be kept out of this.
Right.
It has to be very professionally and very very ethically done.
Right.
That will require subject domain experts. So
Right. Thank you. Thank you, Vikram, for giving us time and wonderful insight. Right. It's a pleasure to host you. And to all my audience who have watched this podcast, definitely wealth is not created overnight. It will take some time. It will take a lot of habit that has to be built inside it so that you can generate wealth year after year. Thank you for watching My Career, My Choice podcast. Please share, like, and subscribe to the channel. Thank you very much.